Ever wondered how the central bank influences interest rates? Understanding the repo rate can change how you see the global economy. Let's understand this secret tool central banks use to control inflation and learn how the repo rate affects everything from loans to savings in this quick explainer. The repo rate, short for repurchase rate, is the rate at which the central bank lends money to commercial banks in exchange for government securities. It's a critical tool used by central banks to control liquidity and inflation in the economy. Imagine central banks like the Federal Reserve or the European Central Bank as the bank for banks. When commercial banks need money, they can borrow it from the central bank at the repo rate. In return, they provide government bonds as collateral. Now, let's dive into how the repo rate works and its impact on the economy. When the central bank lowers the repo rate, it becomes cheaper for commercial banks to borrow money. This encourages banks to lend more to businesses and consumers, leading to increased spending and investment in the economy. On the other hand, when the central bank raises the repo rate, borrowing costs increase, which can slow down spending and investment. For example, imagine you're planning to take out a loan for a new car. If the repo rate is low, the interest rate on your loan will likely be lower, making the car more affordable. Conversely, if the repo rate is high, the interest rate on your loan will be higher, and you might reconsider your purchase. Central banks adjust the repo rate to control inflation. If inflation is rising too quickly, they might increase the repo rate to cool down the economy. If inflation is too low, or the economy is slowing, they might lower the rate to stimulate growth. So how does the repo rate affect you directly? The repo rate influences the interest rates on various financial products like loans, mortgages, and savings accounts. When the repo rate is low, you might find lower interest rates on loans and mortgages, making it cheaper to borrow money. Conversely, the interest earned on your savings might also be lower. For businesses, a lower repo rate means cheaper loans, which can encourage expansion and investment. This can lead to more job opportunities and economic growth. On the other hand, a higher repo rate can slow down borrowing and spending, which might help control inflation, but could also slow down economic activity. In summary, the repo rate is a powerful tool used by central banks to manage the economy. It affects not only banks, but also businesses and individuals by influencing the cost of borrowing and the returns on savings. Understanding the repo rate can help you make more informed financial decisions and better understand economic news. And that's how the repo rate impacts your daily financial life and the broader economy. Subscribe for more.